Hi there, I'm Kai Potter, president of Champion Brokerage Group. First off, thank you so much for watching. I'm creating this video for one simple reason, and that is to educate and empower you. Today's conversation is such an important one, and honestly, I don't believe it's discussed enough. There's a lot of confusion and misunderstanding out there about how financial advisors and insurance agents actually get paid. So my goal today is to clear the air, because how an advisor or agent is compensated makes all the difference for you. So let's get to it. At Champion Brokerage Group, we're completely independent and unbiased. That means we don't represent one company or one product line. We represent you. Our job is easy, and it's to analyze, compare, and design the best strategies for your goals, whether that involves a fee-based plan, a commission structure, or a mix of both. I also want to share some personal context. Before launching Champion Brokerage Group, I spent a part of my career as a registered representative and even held supervisory license overseeing other licensed reps. So I've seen both sides of the business. I know what it's like to work under a broker-dealer with production quotas and product limitations. And I know what it's like to serve clients from a fully independent platform where every recommendation is made solely in the client's best interest. And that is exactly why we wanted to make this video, to help you understand how compensation structures work and how the type of advisor you work with determines the solutions and flexibilities available to you. So there are four main ways advisors and agents are compensated: commissions, fees, hybrids, and then salaries. But here's something most people never hear. The type of advisor or agent you choose directly affects your access to certain products and strategies. A captive advisor works for one company, meaning they can only offer what that company sells. If a better option exists somewhere else, they can't always bring that to you. An independent advisor like our team here has open access to dozens and dozens of carriers and platforms, which allows us to be able to tailor the plan around your goals, not around a company's compensation grade or sales quota. So now let's break down those four compensation models so you can see exactly how each one works. When you understand how someone gets paid, you'll also understand why certain recommendations are made. First, let's take a look at commission-based. This structure is common in life insurance and annuity products. There's usually no additional cost to you as the client, and the advisor may also receive a small renewal payment for their continued servicing of your plan. It's important to note that the commissions are paid directly by the insurance company to the agent or advisor as compensation for the marketing, recommendation, and distribution of the plan, not coming from your account or your investment value at all. In most cases, life insurance pays between 50% and 110% of the first year's premium, while annuities typically pay 3% to 7% of the total amount invested. Let's take a look at some examples. If you start a $200 a month policy, that's $2,400 per year, the agent might earn between $1,800 and a little bit greater, which is paid directly by the insurance carrier, not you. The second model is fee-based or advisory models. In this structure, the advisor charges an ongoing transparent fee. It's usually between 1% and 2%, sometimes higher, and it's based on the total assets under management. So for example, let's say you have a $500,000 portfolio in your investment account, and your advisor charges 1.25% per year. That's an annualized rate, but the fee is typically billed quarterly based on your account value during each period. What this means is that if your account value fluctuates, the dollar amount of the fee will also vary slightly. When your account grows, the dollar fee may be a bit higher because it's applied to a higher balance. If the account declines, the fee will also be a bit lower. Let's take a look at some scenarios. The first scenario we're going to consider is assuming negative performance. Okay, if the market, for example, declines by 2% evenly throughout the year, your quarterly balances might average around $495,000. Applying a 1.25% annualized fee on those quarterly balances would result in a total annual fee of approximately $6,188. Your account might end the year at roughly $483,000, representing about a 3.2% total net change after your fees. The second scenario we're going to consider is assuming a positive performance here. If the market gained, let's say 6% evenly throughout the year, your average balance might rise to $515,000. The same 1.25% in annualized fee would be about $6,440 over the year. After applying that fee, your account might end at approximately $523,000, which represents about a 4.7% net gain. The key takeaway is that the advisory fees are percentage-based, not flat dollar amount, so they move slightly with the size of your account. The client pays the advisory firm directly for ongoing professional advice, their portfolio management, and also planning services. And there are no commissions from the product under this model. This structure aligns the advisor's success with the client's long-term growth while providing transparent, predictable costs. The third model is a hybrid model. These advisors will typically combine both compensation models, managing a portion of your assets for a transparent advisory fee, while also offering protection-based products like life insurance or annuities that pay a commission from the insurance carrier. For example, let's say your total portfolio is $500,000. The advisor, let's say, actively manages $250,000 in market-based investments under a 1.25% advisory fee and helps you place the other $250,000 into a fixed index annuity that pays a 4% commission to the advisor, which is paid again directly by the insurance company and not deducted from your investments or your cash value. Here's what that looks like. The advisory portion, we're going to say $250,000 at 1.25%. That's $31.25 per year, typically billed quarterly. The annuity portion, $250,000 at 4%. That's a one-time $10,000 commission paid by the carrier for marketing and distribution. The $3,100 advisory fee is an ongoing and adjusted quarterly based on the market value of that managed portion. The $10,000 annuity commission is paid once at policy issue and does not come out of your account, meaning the client's full $250,000 is allocated to the annuity contract. In this example, the advisor receives both types of compensation, a recurring advisory fee on the investment side, and a one-time carrier paid commission on the protection side. This approach can help balance growth, income, and principal protection within a single coordinated strategy. As long as the advisor clearly discloses how they're compensated and why each portion of the plan was recommended, transparency is everything. You should always know how your advisor is compensated and for what service. Fourth, we're going to take a look at the salary plus bonus model. You'll typically find these structures in banks, credit unions, and large brokerage firms, often called wirehouses. In this model, the advisor is a W-2 employee who earns a base salary often between $60,000 and $100,000 per year and may receive performance bonuses, which is tied to the business goals, such as new accounts open, assets gathered, or client retention metrics. Let's take a look at some examples. An advisor might earn $80,000 base salary and qualify for a 20% annual bonus, which is about $16,000, for meeting institutional benchmarks such as total deposits gathered or client service scores. While the client may never see a line item labeled commissions, the financial institution still receives compensation through its internal revenue sharing arrangements or product partnerships. A portion of that revenue supports the advisor's salary and bonus pool. One important point to understand is that large financial institutions and wirehouses operate on what's known as a closed or approved platform. Advisors in those environments can only recommend investments or insurance products that have been reviewed and approved by their firm. These offerings are shaped by the firm's internal due diligence process and, in some cases, strategic partnerships, revenue sharing agreements with certain fund families or insurance carriers. While this model provides consistency, brand oversight, and a structured compliance framework, it can also limit the range of available solutions, meaning some competitive or alternative products that exist in the broader marketplace may not be accessible through that platform. By contrast, independent firms operate on an open architecture platform, allowing advisors to access multiple carriers' investment options across the market. That flexibility can make it easier to design plans that align directly with each client's unique goals and preferences. This salary plus bonus structure provides predictable income for the advisor and aligns well with corporate service models. Still, clients should understand how the institution earns revenue and how that structure may influence which products or services are made available to them. The real takeaway is that none of these models are inherently good or bad. What matters most is transparency and alignment. Is your advisor compensated in a way that keeps their interests aligned with yours? At Champion Brokerage Group, our independence gives us the freedom to work with 50 plus carriers and product lines across the market. That means our focus is simple, doing what's best for the client every time. If you'd like to understand how compensation models might affect your plan, or if you just want a second opinion, schedule a discovery meeting with our team. We'll walk you through your options, explain the costs clearly, and help you make confident, informed decisions. I'm Kai Potter with Champion Brokerage Group. Our goal is to leave you better than before we met. Every family, every time. Thanks for watching. And if you found this helpful, please like, subscribe, and share it with someone who needs a clearer path to protection and flexibility. I'll see you in our discovery call.